So is the Chinese economy anywhere near the so-called Minsky Moment? We are joined in our studio in Beijing, Liu Baocheng, Dean of the Center for International Business Ethics from the University of International Business and Economics. Welcome, sir. In Hong Kong, we invited Hong Hao, Managing Director and Head of Research from BOCOM International, that is China's Bank of Communications. Welcome as well. In Washington, D.C., the U.S., we are joined by David Dollar, Senior Fellow with the Foreign Policy and Global Economy and Development Programs at the John Thornton China Center with the Brookings Institution. Welcome, Mr. Dollar. I want to begin with you, in fact, Mr. Dollar. As a longtime China observer, also once served as the head of the World Bank in China, do you think that danger is imminent, so-called the Minsky Moment?
I think the Minsky Moment is probably not imminent for China. You know, I say probably because there's always uncertainty. We can never really predict when economic crisis might start. But China has a lot of strengths. It's built up a lot of debt relative to GDP. That's what people are worried about. That's what Zhou Xiaochuan was warning about. So I think there are real issues. But China has a high savings rate, a state-owned banking system, closed capital account. So probably China can avoid the Minsky Moment. But it would be good to get to work on deleveraging and other types of reforms right now.
What about you, Mr. Hong? Do you hold the same view with Mr. Dollar, or rather differently, as the debt growth rate is doubling almost the growth rate of China's GDP already?
Yeah, I think the debt growth rate is alarming. It's growing very fast, and as you said, you know, it's twice the speed that GDP is growing. But then at the same time, I think when you talk about Minsky Moment, it's a significant moment where you have debt servicing problem. Basically, you know, you can't afford to pay your interest, and you have to raise money to pay your interest. And I think we're far away from that moment just yet. But you know, having said that, you know, because the debt burden is growing very rapidly, so I think that's something to watch out for.
Professor Liu here in Beijing, two things. China in the structural reform of its economic system. We all understand that part of the 19th Party Congress report as well. That means a lot of investment in new areas, so-called, for the economy to grow. Secondly, enormous amount of infrastructure building, both here in China and around the world, providing credit to the other countries as well through different means. So all of this would eventually adding even more pressure, I guess, when it comes to debt for China.
Definitely, yes. You are really investing into the future, but how far will the future bring you for the prospect of the return on investment? So that's need really a long-term calculation, because whether the market sentiment allows you to invest, for example, for a big railroad that can bring the return in 20 years. And as long as the market doesn't collapse, as long as people still have a high savings rate, and also as long as the Chinese monetary authority and also the financial authorities at large are able to have this solidity to take decisive measures in terms of the curtailing the capital flight, in terms of the swapping between equity versus the debt. So that's something that you know, that's something that I feel more positive about China. And the other thing is that many of the local governments are investing actually more in the infrastructures. So instead of, you know, paying more to the pension funds or paying the retirees, etc. So therefore, those, you know, solid assets, if they are there to be allowed to privatize, you know, the debt can really be substantially reduced.
But we are talking about a lot of ifs, right?
That's right.
At this point, none of those ifs have become reality yet. So that is the issue. Mr. Dollar, exchange rate. China is moving its direction toward an international standard, and that has been applauded by the IMF as well. So that means the authorities should not have an iron fist toward how the exchange rate will be done. And therefore, that is good on the one hand, but on the other hand, it provides space for risks, as Professor Liu earlier mentioned. So in fact, when China is becoming more market-oriented, there is so-called bigger risks that would face China when it comes to danger of the Minsky moment. And yet, we cannot delay that process of being more market-oriented. It's important for the Chinese economy in the overall. So what do you think, Mr. Dollar? Can we still have so-called the advantages that all of you mentioned, Mr. Dollar?
Yeah, so I think you're absolutely right. China needs to move in a more market-oriented direction, but the sequencing of that reform is very important. I would not be in favor of opening up capital. I would not be in favor of opening up China's capital account quickly. You know, you might think of complete marketization, just open everything up. That's not what the IMF's recommending. It's not what I would recommend. I think China should open up more to direct investment. And it was great to hear Xi Jinping talking about opening up the service sectors. And you can bring in financial services. That's important. But opening up the capital account, letting a lot of money move in and out of China easily, I think that's a long way off. And to me, that's one of the big risks. If they move too quickly on the capital account, there'll probably be a big outflow and a depreciation of the currency, and that's not going to be good for China, and that's not going to be good for the world.
But on the other hand, Mr. Hong, you probably understand very well about this. I mean, at this point, 19th Party Congress report, they talk about the so-called major contradiction. That is the demand for a better life about the Chinese people vis-a-vis, you know, insufficient development, unbalanced development. This also coincides with Chinese common people's demand of, you know, having a total control of what they want to invest, where to invest, whether they want to invest in China or somewhere else. You know, this ultimate contradiction needs to be resolved according to the 19th Party Congress. So how are we balance these? You know, on the one hand, you have an ultimate goal. On the other hand, there seems to be some issues that need to be worked out. Mr. Hong.
Yeah, I think gradualism is the key here, and I think, as Mr. Dollar said, you know, it's going to help to stabilize the financial system as you open it up. And I think for the Chinese people, yes, you know, we do demand more investment opportunities. For now, most of the Chinese investments are domestically oriented, and also most of the Chinese family wealth is really residing in the housing sector. So, you know, if you open up a financial market for Chinese money to invest overseas, it can actually diversify many of the Chinese families' asset bases, and therefore, you know, diversify some of the risk that is inherited with, you know, investing only domestically. So I think, you know, gradualism is the key here, even though in the long run, you know, we do see Chinese money investing gradually more and more overseas.
Gradualism is the key. That has been talked about, yet the question is, how gradual? Who would be able to have that kind of judgment? What are some of the most important barometers that would examine in order to decide the speed of so-called gradualism? Mr. Dollar, you got some input?
Well, I think it's useful to distinguish between direct investment and portfolio investment. Direct investment is when foreigners come in and start firms or buy firms. And China's been quite open to direct investment in manufacturing, but the service sectors are still very closed, including financial services. So I think you could move quickly to open up more to foreign investment in direct activities, and that's going to help stabilize China's financial system. We see a lot of Chinese money going out in the same form, so I think that's all very healthy. What I worry about is if you opened up the portfolio investment quickly, you would probably see a lot of Chinese money leaving, and that's going to be destabilizing. So it's partly a question of being bold in the right areas and being cautious in the right areas. And so it's really quite an art to get all of that correct.
It is art, isn't it, Mr. Hong?
Yes, I think, you know, one of the great Chinese leaders once said, you know, we cross the river and, you know, as we feel the stones. So, you know, it's a really trial and error process. In 2015, you know, we have a currency reform, but that creates quite a bit of market volatility, and it actually delayed the rate hike schedule for the U.S. Fed. So I think it is a trial and error process, and I think, you know, for now, you know, ever since 2017, when we have the market currency rate stabilized, it actually benefited not only the Chinese domestic financial market, but also the world market as well. And as you can see now, after almost 12 months later, we're seeing a synchronized economic recovery across the globe. And I would say that, China has been a major contributor to this recovery.
But overall, Mr. Liu, Professor, I want to ask you about this because after that warning has been given out by the globally respected Chinese Central Governor Zhou Xiaochuan, particularly it seems that almost at the end of his term, right? He's likely to retire according to his age. But you think about that, and then people talk about what exactly is the danger that China is facing. Is it really the Minsky moment? Or is it really the downward pressure of the economy? The growth rate or lack of growth rate, lack of the real engines for the growth rate, that is the biggest danger. And of course, when we have different focus, we're going to allocate our energy in different areas. So what exactly is the main conflict here? To you, Professor.
Well, I think the bulk of it is really the quality of growth. You simply translate money by recounting it, in a Ponzi scheme type of way. Yes, you create a GDP very quickly. It's like, I trade your pen and you trade to others. So that doesn't really help the economy. So for long-term investment, I think China has really benefited a good deal. We have made a number of bold steps that may not really bring a quick return, but we are really paving the way for industrial cluster and for mobility of economic resources.
Yeah.
So that's something that that's beyond comprehension of many even economists in the world.
Okay.
So I would really hold a lot of optimism. And the other is that to liberalize capital account, we worry about the hot money flying in and out. But if the market really does give the promise for those investors, the hot money can reduce their pressure and get parked in those rewarding businesses.
One of the things we can do, gentlemen, is to do some comparison. That would help us to clarify our mind and also help the world to understand exactly what is the situation in China now. Okay, so let's do some comparison. 1997, let's see, the Asian financial crisis. Mr. Hong, as someone who has been in the financial circle in China for long, you probably would help us to understand that. That was one of those, as they say, Minsky moment for some of the Asian economies. 1998, you have also the Russian problem. Then, 2008, you have the overall financial crisis, particularly in the West. Many of the people commented about a Minsky moment related to all these three cases. Mr. Hong, from your perspective, how is that compared to what China's danger might be in the future, Mr. Hong?
Yeah, I think China now is in a far stronger footing right here at this moment in time. And I think back in '97, the problem with the smaller Southeast Asian countries really is that they invested a lot of money in very low return projects, and the cost of financing has become quite high, ever since the Fed was raising interest rate back then during that period. So it creates a problem when you put money into wasteful projects, but your financing cost is rising. And also these smaller economies, they have an open capital account, but they have very little forex reserve. Now, as opposed to China, what China have right now is like more than $3 trillion forex reserve. So I would say that number one, comparing to back then, those small Southeast Asian economies, China has been careful with its money. The savings rate is very high,
right?
And also China has a huge forex reserve. So I wouldn't say China is facing Minsky moment anytime soon.
I see. I want to thank you, Mr. Hong, for joining us. I hope you will join us in the future. I know you have something to do at this moment. You have to run, but thank you so much. I want to go to you, Mr. Dollar, about that question too, particularly from the American perspective. When you see 2008 financial crisis in the Western world, and you see a warning of Minsky moment here in China, what does that say to you?
Well, the three cases you mentioned, Tianwei, are all characterized by large net capital inflows contributing to high asset prices. This was particularly clear in Thailand and Russia, but even in the United States, the big boom in the mid-2000s was very much driven by capital inflows. In the U.S., then you have to add that there were real regulatory failures. There was a vast shadow banking sector that was not regulated. So looking at China, I agree with Mr. Hung that China's not got large capital inflows. It uses its domestic savings, and as he said, it's got $3 trillion of reserves. So I agree with him that China has buffers. I think one lesson you should take from the U.S. is that regulating the shadow banking system is very important. The fact that it's not, it's not commercial banks. What we learned is we treated that as a sector where we didn't really have to pay attention, but that became so intertwined with our banking system that it really caused an enormous crisis. So China has a big shadow banking sector also. That's part of the problem with this growing leverage. So I think you have important differences with the U.S., but I think take the lesson that you want to regulate that shadow banking sector very carefully and prevent the overall growth of leverage.
I see, but Professor Liu, shadow banking system is still a big problem for China as well, because China's financial system is not yet fully developed, so there are spaces like that for shadow banking to prosper. And for some time, actually, it serves certain purposes, but for the longer term, it's not the way to go. And yet, the system cannot be developed overnight either. So, Professor Liu, help us to solve this riddle in a way.
Well, that's an immense amount of job. Shadow banking is really considered to be a black market in the financial area. So you remember that China had a huge black market between RMB and versus any foreign currency 20 years ago, but gradually when we really converged the real value, and the black market quickly disappeared. So if we are really there to bring more of the state-owned banks more onto the market-driven rate, so shadow banking can disappear. So therefore, we need the big financial reform in the state-owned banking operation. And the other, if you look at the debt structure, that state-owned firms, they have the highest debt ratio. And this is really in stark contrast versus private firms. So how we can really reduce the debt by either supply-side reform or institutional reform that are really owned by those non-performing state-owned firms. So that's a very decisive solution that faces the challenge of the Chinese top leaders.
And yet, that challenge is imminent. The Standard & Poor's, for example, commented recently, China still needs bigger strides in deleveraging. It says, while credit growth is showing signs of slowing, it is expected to continue outpacing economic growth, leaving China with thinner financial buffers to deal with any crisis. You could see that problems. Of course, these rating companies always warn about the crisis in advance, but, Mr. Dollar, this is something that China needs to do well, at the same time deepening its reform. It's mentioned once and again in the 19th Party Congress report. It's also mentioned by Xi Jinping, the General Secretary, after the Standing Committee member of the Politburo were selected and for the very first time facing the media. He said reform opening up. How is that likely to help China solve this problem, Mr. Dollar?
Well, I think Professor Liu made an important point that the debt is, the leverage is higher among state enterprises. And so when we talk about deleveraging, what we really need to point out is that this is going to raise the cost of capital in China. This is going to raise interest rates in real terms. That'll be good for savers, but it's going to create problems for some of these state enterprises. And in his work report, Xi Jinping said that firms should survive based on competition. So this is really an important issue. Is the Chinese leadership, will they be willing to let some state enterprises, particularly at the local level, go bankrupt and exit from the market, which is likely to happen if you really follow through on deleveraging? And so I think these reforms that they're talking about, they're really quite critical. And the key question is, what will be the implementation over the next 1 to 2 years?
Yeah, actually, there are some barometers already set and time-posted by the Chinese Communist Party leaders during the 19th Party Congress. Remember, Professor Liu, you were there in the studio listening to it. I mean, next year, the year after next, supposed to be moderately prosperous Chinese society, get rid of poverty. All of this requires a lot of financial support from one area to another. So all of these actually mixed up. There has to be a plan and has to be a starting point.
I think, running a country is like running a family. If you have the right sentiment, if you have the enthusiasm, you can really wait until a longer period of time for a fruition of the results. So therefore, the roadmap and the timetable is there, mapped out by the 19th Party Congress, and which are really realistic. So therefore, if we are really to mobilize, those resources together and to bring up the right type of market sentiment, I think the situation is still manageable, and people do have confidence in this round of leadership and in this government.
Mr. Dollar, you want to have a say also about this?
Well, one of the important goals of the Communist Party leadership was to double the GDP between 2010 and 2020. Frankly, because of the rapid growth of the recent years, China is very, very close to this goal. You only need to grow at 5.3% for the last couple years to reach the target. So I do think the authorities can let the growth rate slow down. That's what's going to happen if they really tighten credit. But if the growth rate slows down, you're still going to meet those important social targets for 2020. And I think that's the kind of balance that the new leadership is aiming for.
But that has to be quality growth. If the growth rates are going down, it has to be a quality growth that we are talking about here. For now, I want to thank the two of you for being with us, helping us to understand the concept of so-called the Minsky Moment, how far China is from it, and the urgency China has in order to reform its economy. Thank you so much. David Dollar, Liu Baocheng, really appreciate, gentlemen, for being with us.